Hi, this is Jeff Evans taking you through the ratio questions on level 4 financial statements for limited companies. First video covered questions 1.1 and 1.2, so cash flow and statements of changes in equity, and also 1.6, which was a consolidation question. This one will cover the ratio questions 1.7, 1.8, and as I say to students, big questions, 20 marks for this one. And for 1.8, that's 30 marks, if I'm not mistaken. So 20, or 23, sorry. 23 marks. So it's a big question, so you need to get those and understand them when it comes to doing these particular questions in the exam. Okay, so let's go through this one. So this is Phoenix. There's Phoenix profit loss account, and their statement of financial position. And we can see here, you really need to understand these ratios because they prop up in most of or a lot of the assessments on level 4, but equally, you need to understand them for when it comes to particularly 1.8, where you need to explain the ratios and what's happening. So what's on the bottom, what's on the top, so on and so forth. Anyway, so for this one, it says, so the first one we've got is the inventory holding period. So what formula is it for the inventory holding period? So we've got inventory holding period, which is inventory divided by cost of sales times 365. So how long do you hold on to your stock in days, this one says. Okay, so again, if your sandwiches, you want to get rid of them quick as you can. If it's white goods, such as fridges and freezers and blah, blah, you're going to probably keep them longer. And if you sell aeroplanes, then you're probably going to hold on to even longer, aren't you? So for this one, let's have a look. I'll do the calculations with you so you can see them. Calculator. So this one, as we said, so your inventories, which are 4620 divided by cost of sales. So 4620 inventory divided by a cost of sales divided by 47875 equals and times 365 for days. It's a 1 decimal place of 35.2 days. That's how long you're holding on to your stock for. Current ratio, so is your current assets over your current liabilities. Important for liquidity. You know, when you're borrowing money or I don't know, investing in a company, you want to see, you know, how quickly can you get your money back? So what current assets have they got over the current liabilities? So your current assets in this one is 16,259. So 16,259 divided by the current liabilities, so 9,238. So divided by 9,238 is 1.76. So round it up to 1 decimal place. So that's a 6. So 5 or above, we round it up. 4 and below, we'll leave it 1.7. So this one is 1.8. So 1.8 times assets to liabilities. So every pound of liability, we've got £1.80 of current assets. I do say to the students that, you know, is a current ratio of 5 to 1 any good? Or 10 to 1? Could be. Might not be. It could be. If it is 5 or 10 to 1, then what would the reasons for that be? So you look at these here, don't you? It could be to do with high levels of inventory, so too much stock. You don't want too much stock because it'll become obsolete and out of date, won't it? You certainly don't want too high trade receivables. So if your current ratio is so high because of your trade receivables, again, that's not necessarily a good thing, is it? Because you get things like your bad debts then, don't you? So not necessarily good. And similarly, with bank and cash and things, cash and cash equivalents, you know, so again, if that's the reason why it's high, then maybe you should be doing something better with the money to get a better return. So the current ratio is current assets over current liabilities, not the quick ratio or acid test ratio, which is when we take the inventories out, because that's the least liquid, isn't it? Inventories, because you've got to sell it before you turn it into cash. Okay, so that one was 1.8. The gearing ratio, total debt divided by total debt plus equity. Okay, I'm going to do this one with reference to how you would do the same with capital employed. okay? Because some of these, particularly the cash management question, you tend to include your overdraft, but in this one they haven't. So it's similar to what they've used for the capital employed element for return of capital employed. So all they've done non-current liabilities plus non-current liabilities plus equity, okay? So again, I'll just show you, see what I've done for this one. Whoops, daisy, sorry, let's go back. There we go, calculator should have pressed. So for this one, what they've done the bank loan, so non-current liabilities, which is 32755, okay? And then they divided that by the non-current liabilities plus the equity, which is 47624. 47624, which is 8379. Let's go back again. So your non-current liabilities are 32755 divided by non-current liabilities plus your equity, which was divided by 8379 equals, and then multiply it by 100 percentage equals, so 40.75. Okay, so again, rounded to one decimal place is 40.8, which is where we get that one from. Asset turnover. So how well do you use your assets to generate revenue? So it's revenue divided by total assets minus current liabilities. Okay, so how well do you use your net assets to generate revenue? Again, just be careful, because if it just has asset turnover, it will be revenue divided by total assets, wouldn't it? Which would be that one. But this one is basically looking at how well do you use your assets to generate your revenue. So your revenue is 86,482. Your total assets are 89,617 minus your current liabilities of 9238. Let's have a look. So we've got 9238 total. So 89,617 minus 9238 is 8379. See, same as like capital employed, isn't it? Same figure used before. So 8379. And we are going to divide it by the revenue. So revenue. 81, that's right, that's right, okay. So 8379, and we're going to divide it by the sales revenue, 86,482, divided by 80,379 equals, so 1.07. So we're going to round that to one decimal place, which means that that's going to move to 1, which is 1.1 times. Yep. So your revenue, so your assets generate for every pound, £1.10. Yeah. So it just generates 1.1 times revenue over assets. Okay. And finally is return of capital employed. So return of capital employed, as you can see, is our profit from operations, which is 14,637. And this one is the same as what we did before. So your total equity plus your non-current liabilities. So your non-current liabilities are 32,755, which is what we did before. And your total equity is 4,7,624, which gives us 80,379, which is again the figure we looked at before. So let's do it again. So we've got profit from operations, which is profit from ops is 16. No, it's not. It's 14,657 divided by 83,779 equals times 100 is 18.23. So again, 3 being lower than 5, so that stays at 2. So 18.2% is our return of capital employed. Yeah. So again, your capital employed is very similar to what you're using to the bottom of your gearing figure, isn't it? See, yeah, non-current liabilities over your equity. All right. So we'll just bear that in mind when it comes to doing the particular questions. So that's that one. So that's 20 marks. And then the next one I'm going to show you is 1.8. And again, I'll stress the importance of understanding how the calculations or how the formulas are calculated, because they're the reasons why there are changes. So this one said that Lisa Brader is a potential investor and asked for your assistance in analysing Arizona to help with her determine whether or not she should buy shares in the company. She's recently received a large cash sum from a pension plan and is keen to invest in Arizona Limited after reading a report in the newspaper that the industry sector in which they operate is performing well. So you're calculating the following ratios in respect of Arizona using the most recent financial statements and have obtained an industry average for comparative purposes. So return of capital employed is 11.5% for Arizona against an industry average of 14.3%. Okay, so again, it says assess whether each of the ratios is better or worse as compared to the industry average, and to say what this might tell you about the company. So I'm going to split my screen with you now because I want to show you something. Some of the things I say to the students, always, 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 is make sure that you state the obvious. Is it good or is it bad? So is Arizona's return of capital employed better or not in relation to the industry average? It's not, is it? Because they're 11.5% against 14.3, means it's worse. Well, why is that? And this is why you need to understand. So how did you do your return of capital employed before? So what are the reasons for that being worse than the industry average? So let me show you. I'm going to go through the answers with you because it's an easy way of doing it and I can explain it to you as you're going along. So watch. So let me show you. Okay, so let's have a look at the first one. So again, as I said before, you get 1 mark for saying that it's worse. If you don't put that, you're not going to get the question. You're not going to get that 1 point. As I say to the students, state the obvious, okay? So what's the reason for that? Well, you know that return of capital employed is profit from operations over your capital employed. So is it to do with profit? It might be your profit's not as good as the industry average. Could be, couldn't it? Or it might be to do with your capital employed on the bottom, which is, is your equity against your non-current liabilities. Maybe they borrowed more money, okay? So again, you can see here, so again, explain what's happening. So first one, is it better or worse? Well, it's clearly worse. The reasons for that, so the capital is working less efficiently in terms of generating profit, i.e. less profit generated by capital employed. That's just explaining the obvious, isn't it? Because you know the ratio, don't you? You did it in the previous question. So why is that? It could be due to lower profits, as we said before, higher equity, or high non-current liabilities. Again, you need to know the formula so that you can explain the reasons why that might be the case, okay? And the thing that they tend to like when you can link the formulas together. So interest cover, will come into that in a bit, okay? We'll come to that when the time arises. So again, state the obvious, it's worse. Why is it worse? It could be to do with profit on the top, so less profit, or it could be to do with what's on the bottom with reference to your capital employed, whether that's your equity or your non-current liabilities, okay? Your working capital cycle, as I say, IRP, so inventories plus receivables minus payables. So how quickly does that cycle go? Well, 18 days for Arizona, that's good, against 28 days for the industry average. So that's how quickly your turnover, your inventory, you receive your money from your supply, from your receivables, to how quickly you pay your payables. So that the quicker the better, okay? So inventories plus receivables minus payables. So it can only be to do with those, can't it? So is it better? Yes, we can see. Working capital is better. Okay, so maybe that's to do with the fact that your cash is tied up for shorter period. So working capital is basically your, obviously working capital is your current assets minus your current liabilities, isn't it really? So it's thinking about those types of things, isn't it? Yeah, working capital, current assets minus current liabilities, so that's the reason why. So inventories may be turning over at a quicker rate, so it could be to do with your current assets. So shorter inventory holding period, but then I said which is the working capital cycle, that's right, yeah. Okay, but working capital is your inventory, current assets over current liabilities. It could be that it's better that you're collecting your debt sooner. So look at your trade receivables. So you might be collecting them quicker than what the industry average is, or you might be paying your creditors later. So longer trade payables and payment period. So just take those a bit of a time. So inventory. So you're collecting your debt sooner, trade receivables collection period, or you're paying your creditors later. So again, they're the reasons why it could be that it's better than the industry average. Okay, but again, state the obvious. Acid test ratio, which is current assets minus your inventories over your current liabilities. So 0.9 to 1 as opposed to 1.5 to 1. So this is worse, isn't it? So why is that? Current assets on the top, okay, minus inventories, or current liabilities on the bottom. So therefore, again, it's worse. So it's more risky. Again, the consequences of that, it's more risky, less solvent, and say liquidity issues. You might struggle to pay the short-term debts because that's what that ratio tells us. Okay, it could be, as it said before, it could be lower trade receivables or cash and cash equivalents. So they might not have got. It's not necessarily a good thing to have a high acid test ratio, but it could be because again, if it's too much stock or your debtors is too high, well, that might be it might be because you've got less receivables than the previous than the industry average. Or again, just think about what your current assets are, okay? Which is what I say there. So consistent with shorter working capital cycle, again, so 0.91 to 1.51. So again, maybe it's the receivables and that top part of your current assets bit, all right? And then finally, we've got interest cover. So profit from operations over finance costs. So you've got interest cover 2.2 times, which is the Arizona, which 3.5 times the industry average. So therefore, they can pay their finance costs out of the profits 3.5 times. They can only cover it by 2.2 times. So it's not as good. Okay, so why is that? Again, it's either the profit, which falls in line with the return of capital employed part. So maybe your profits aren't as high as the industry average, okay? Or you might have taken out more borrowings, which therefore has an impact on your finance costs. And you can see here, so less profitable to meet the interest payments, so more risky again. May be caused by lower operating profits, as you said before, which falls in line with the top one. Maybe higher interest payments, so the finance costs on the bottom. So may have more debts, loans. So you've got all these things. You've got 5 marks, haven't you? So any of these will give you the marks that you need. So again, just think about what's on the top and what's on the bottom. First thing we said before, basically, is the fact that, is it worse? There's 1 mark. So this one is worse. And then why is that? And then we said it could be to do with profit, be less, which falls in line with the return of capital employed on above, or it could be to do with the finance costs on the bottom. So maybe they've got more borrowings, so therefore the interest is more, and that has a negative impact in relation to Arizona. So that makes sense. So that one's worse, that one's better, that one's worse, that one's worse. So 3 out of 4 are worse. So would you tell her to invest in that particular company, which is where you get your 3 marks from? Advice is not to buy shares, isn't it? Because there's only working capital cycle, which is better. Okay, as it said, could be due to taking longer to pay suppliers. And again, you get 3 marks for that, aren't you? So you're just explaining what you've already explained, haven't you? So that's it in relation to that particular question. So again, please, as I say to students, state the obvious, and then know your ratios, so you know what's on the top what's on the bottom, and therefore you can then explain as the reasons why the changes. Okay. Thank you very much. Let's stop.